6:05. While we so be respectful of everybody's time, we're gonna go ahead and get started. It gives me like great honor this evening to be introducing our speaker and our guest speaker for the meetup tonight. Mr. Brian Burke is somebody that I highly respect, that we highly respect here at Excite Capital, that has been a great influence in us, in our growth as well. From reading his book, which I say is the best. I still call it the best book for anybody that's looking to be a passive investor in multifamily real estate. The book is The Hands-Off Investor. I remember the day Tenny was the one that got the book when it came out and started reading it. He called me, was like, Leslie, you got to get this book. I'm like, man, I'm reading another book right now. He's like, no, you got to get this one. So while we are active investors, the book is also, I think it's kind of like if you want to think about multifamily investing as a course, that's a great textbook for you to study and understand the business. Even though it's written for passive investor, it's a great resource for active investors as well. And we recommend it for anybody that reaches out to us asking for any kind of mentorship. So without further ado, I'm going to go ahead and introduce Mr. Brian Burke, who is the president and CEO of Praxis Capital, a vertically integrated real estate private equity investment firm, which he founded in 2001. Brian has acquired over $800 million worth of real estate over the last 35 years, or the last 35 years of his career, including over 4,000 multifamily units and more than 700 single family homes, guys. With the assistance of proprietary software that he wrote himself, Brian has subdivided land, built homes, and constructed self-storage, but really prefers to reposition existing multifamily properties. Brian is the author of the book I mentioned, The Hands-Off Investor, a guide to investing in passive real estate syndications. And guys, if you don't have that book yet, go ahead and search it on Amazon and buy it. And Brian is also a frequent speaker at real estate conferences and events nationwide. So it's a great honor. Without any further ado, I'm going to pass it over to the man himself, Mr. Brian Burke.
Really appreciate that, Leslie. Thanks for that wonderful introduction. I'm going to try to live up to that and see if I can meet the expectation. I wrote that book because a friend of mine lost her entire life savings investing in a passive real estate syndication. And I felt that if there was one thing I could do to prevent that experience from happening to somebody else, writing the book and all the effort that goes into it would be worth it. And hopefully it's been successful. This is a market where it's been a trying time for the last few years in the syndication space. And investors are running into challenges. Deals are running into trouble. Some investors are losing money. And this is going to be an interesting discussion to kind of talk about all of that stuff. Now, whether or not any of the advice from the book rang through to people and prevented some from investing in some of these bad deals, I suppose remains to be seen, and I may never know the answer to that. But I'm sure going to hope that maybe it played some role somewhere, somehow. I've got a few slides that I created that I want to share with you guys today, and some prepared remarks just to get the discussion started. Ultimately, I want this to be an audience participation event, and want people to feel comfortable asking questions. And I can guess what kinds of things people might want to hear about or might want to learn about, and maybe I'll be right and maybe I'll be wrong. So I think the best way to deliver the best information is for you guys to ask the questions that I can answer. And I think questions will come to you as I go through at least my initial prepared remarks, which will probably take about a half hour, and that'll leave us about 20 minutes for questions. So if you think of something, type it in the chat box, use your raise hand feature, scream and yell, whatever it is you have to do to be a part of the discussion afterwards. So just wanted to get you thinking about that so that you're thinking of your questions. so we can get to those. So I came up with this little, it's funny, I haven't done this particular presentation before. I've done a lot of different talks on real estate, but I created this one custom just for you guys. And I called it Passive Real Estate Syndications Dead or Alive. Because I've heard people asking the question lately of, is investing in real estate syndication a thing of 5 years ago or 10 years ago? And nobody's doing it anymore. Is that where we're at, really? Well, I want to try to clear the water on that and see if we can figure out whether it's a viable investing strategy or not. Uh, just some follow-up background to the great introduction that Leslie already gave. I won't spend a lot of time on this. He already mentioned I've been investing in real estate for over 35 years, 4,000 multifamily units, 700 single-family homes, blah, blah, blah. I've also lent over $2 billion to real estate investors, fix and flip investors, small multifamily, that sort of stuff. I had a lending company that I owned for about 5 years that I sold 2 years ago. I've raised over $350 million from investors for over 40 different offerings to invest in real estate and real estate debt. I'm also on the other side of the table as a limited partner, as a passive investor, and not only in my own real estate syndications, but in other people's real estate syndications, as well as investments outside of real estate. And I think this is an important point that I want to get across, is that real estate's not the only investment vehicle in the world, guys. I mean, there's other things that you can invest in too. And I know those of us who are in the business of creating passive real estate opportunities for investors, it's not really towing the company line to say that there's other things you can invest in. We should be saying that the only thing out there is real estate syndication. That's the best investment you can make. But the reality is there's a lot of alternatives for you. And as syndication sponsors, we need to be cognizant of the fact that investors have choices, and we want to make our choices be as competitive as anything else out there. And that means that we have to find good deals, manage property well, and be a steward of people's capital. Personally, I've invested in pharmaceutical startups, new drug inventions, oil and gas ventures such as oil drilling, agriculture. I'm a heavy investor in an early stage company that's developing new seed technology, and also in lending. So I've got a little bit of experience investing in a variety of things, and I can say with that experience that some of these things are just as good as real estate. But you don't put all your eggs in one basket. You spread your money around. You still want real estate as part of your portfolio. I started out flipping houses 35 years ago, and got into multifamily about 20 years ago. I added about 7 or 8 years ago, added some really heavy hitters to my team that come with tens of thousands of units of multifamily experience over multiple decades. And these guys have helped me build this business to 4,000 units. And then they also helped me take it all the way back down, because I no longer own 4,000 units. I sold 3/4 of my portfolio just before the peak of the market in 2021 and 2022. I managed to get out of most of that stuff before pricing fell. And I'm going to talk a lot about what pricing has done here in just a moment when we get to that part. My operational experience and that of our company has been across the U.S. We've actually owned or managed in more states than I have in blue, but these were the only ones that I could find in our records. So I highlighted those states in blue where we've had more recent current operations. Our total operational experience between the four main partners is 106,000 units. So that's kind of like the value proposition. I think if you're a passive syndication sponsor, one of the things you want to do is describe to your investors what sets you apart from your competition, and why they should invest money with you as opposed to somebody else. Our value proposition is that we've got tons and tons of experience through multiple market cycles. Other people's experience is something completely different, and everybody adds value in their own way. We already mentioned the book, The Hands-Off Investor. No need to spend a lot of time on that, but Leslie mentioned you can check it out on Amazon. You can also order it straight from the publisher. It was published by Bigger Pockets Publishing. You guys might be familiar with the website Bigger Pockets. It's a great resource for investors. Great place to check out. They're about to start up a new website called Passive Pockets, which is going to be designed to cater to the passive investing community, syndication sponsors, and passive investors, which is going to be really, really cool. And I'm going to be involved in that and helping them bring that to reality. So let's start off with the very basics. What is a syndication? I think most of us on here are probably familiar with syndication in one way or another, but let's find another way of describing a syndication maybe you hadn't thought of. Just the simple dictionary definition. If you look up the root word of syndication is syndicate, and the definition of a syndicate is a group of individuals or organizations combined to promote some common interest. Now, we know that in this business as a syndication sponsor gets in contract to buy a parcel of real estate, and they go to their network of passive investors to provide the funding. And then together they go and they buy this property, and the syndicate sponsor manages it, and the investors just give the funding. And this is a definition of what that really is. But Merriam-Webster also has a definition of the word syndicate, and their definition is a loose association of racketeers in control of organized crime. So I think your job as a passive investor is to determine which of the two kind of syndication sponsors are you investing with. Are you investing with someone that has a common goal of promoting a common interest and investing in a profitable parcel of real estate? Or are you investing with some crook that's going to steal your money and run off with it? And that's what happened to my friend who lost her entire life savings. The sponsor that was in charge of that deal is in prison, has been in prison for almost a decade now, and might be in prison for another decade for all I know. So real important to determine who you're investing with. I think it's more important than what you're investing in. It's who you're investing with. Now, some passive investors have found themselves in a bit of an uncomfortable situation lately where maybe their syndication sponsor, isn't a crook, but the market hasn't been helping them out. Things haven't been going well. Maybe distributions have been paused, and people are wondering, have I lost all my money? Is this investment failed? Is the sponsor even still in business? A lot of questions are coming up lately as deals have run into trouble. And is my money lost? It's kind of a difficult question to answer because there's so many variables here at play that you have to dig down to figure out what's really happening. If distributions have been paused, this is probably the most important time for you to have communications with the investment sponsor in charge of your investment. You want to get answers to what's going on, and hopefully the sponsor is ahead of all this and is telling you what's going on before you have to ask. But a lot of sponsors don't. Getting into this business, there's a fairly low barrier to entry. There was a phase here where just about anybody could be a syndicator. It's a little harder now, but a couple of years ago, there were a lot of people getting into the business that probably shouldn't have been in the business. So maybe they were really good at real estate. Maybe they were good at finding deals, or maybe they had a really good network of investors and they were good at real estate, but weren't really good at managing money or fund administration, investor relations, all those different kinds of things. So those things fall through the cracks, and investors are left wondering, what's really going on over there. And the worst case scenario is when the sponsor goes completely incommunicado, and all of a sudden they're not sending out quarterly reports, or their quarterly reports are not complete enough to tell you what's going on. Or worse of all is they're not responding to you at all when you inquire by email or phone to ask what's going on, and you don't get any kind of response. So it's happening a lot more than we would like to think would be happening right now. But the root reason behind why distributions are paused is going to give you clues into whether the money is lost. So assuming you can get communication with your sponsor, the things you want to find out are what is the loan to value ratio? When is the loan due? Uh, why are we pausing distributions? What's going on with the income? Is the income increasing or declining? How much cash do we have? And are we going to run out? Those are all things that you really want to know when distributions get paused. Now, in an ideal world, a paused distribution shouldn't be a big surprise, because before they even get paused, the sponsors should be saying, these are the challenges that we're having. Income is declining, or interest rates are going up, and debt service is getting more expensive, and there's less free cash flow. That communication should be happening long before distributions stop. So hopefully this isn't a surprise, but I've heard more than one case where somebody's completely blindsided by the pause in distribution. So just a few things to think about. The next issue that I've been hearing a lot about is capital calls. This has been a big issue lately, where sponsors are issuing unplanned capital calls. And this is where the investment sponsor asks the passive investor to invest additional capital into the deal because there's some kind of problem that they're looking to solve. The real question on your end as a passive investor is, what problem are we solving? And is the capital call that you're asking for going to permanently solve the problem, or is it a band-aid fix? What you don't want to find yourself in the position of is throwing good money after bad. Let's say you invested $100,000 in a syndication. Now they're asking you for $20,000 or $30,000 more. Does that mean that you're going to lose 130,000, or are you going to lose your 100,000, or are you going to not lose anything at all? So some ways to sort out whether or not a capital call is throwing good money after bad is thinking about, what are the long-term threats? What's the current liquidation value of the property? In other words, if we were to sell today, how much of my original investment would I be expected to get back? If it's 100%, then maybe selling is a really good idea. Just get out, go invest in something else, and make your money on the next deal. If they say that if we sell now, you lose everything, then that also actually makes the decision of a capital call a little bit easier, because if they actually have a plan to salvage the deal, and a sale right now would be a complete wipeout, then the return on investment of called capital could be quite high. Like, let's say, for example, you could put in an additional 30% of your original investment. So you invested 100,000. If you put up another 30, we're going to be able to save this deal, hold on for another 5 to 7 years, and sell and at least get, our investment back. Well, now on that $30,000, you could be looking at $130,000 return in 5 years. Well, that's a really good investment. Where it gets a little difficult is if the liquidation value is somewhere in between, because now if they say, well, you can get half your money back if we sell today, now you have to weigh, what could you earn on the 50,000 you got back versus risking another 30,000 to try to get the whole 100 back. That calculus becomes a little more challenging when there's a partial capital recovery. But some of the things you want to think about when you're issued a capital call is the loan maturity. When does the loan mature? If the loan matures in 1 year or 2 years, and the capital call doesn't solve that problem by allowing for an immediate refinance with a longer term loan, then you could be throwing good money after bad, because in 1 or 2 years, when that loan matures, you're going to be stuck up a creek and you have nowhere to go. If the loan has a floating rate, when does the rate cap expire? And how much will it cost to buy a replacement rate cap? And will there be enough money to buy a replacement rate cap? That's something to think about. What's the current property value and loan amount? What is the cash flow situation? Or is it positive cash flow or negative cash flow? What does that look like? And if the sponsor were to get all of the called capital, will this carry the project to the next market cycle? Or is this just going to buy you 6 months? It's going to buy you a year. Maybe it buys you 2 years. That might not be enough, because this is a pretty deep market depression, and you don't want to find yourself throwing good money after bad by funding a temporary fix to a permanent problem. So there's a few things to think about on the capital call side. Now, amongst all that depression of like, geez, pause distributions, capital calls, loss of capital, what about, should I invest now? And some people, I'll tell you that when you've experienced some of the negative things we've just talked about, those scars and wounds heal very slowly. And, I've talked to a lot of investors who have said, I'm not investing in those passive syndications anymore because you lose money, you get capital calls, your distributions get paused. It's just a total nightmare. And the reality is really that's just a vintage risk, right? When the market turns against you, the deals that are already done are going to suffer. But the deals that haven't been done yet can present a real opportunity. Now, before we started the webinar, Tenny and Leslie and I were kind of chatting about the current capital raise environment. Like, they're raising money for a deal, and it's like raising money for a deal isn't as easy as it was 2 or 3 years ago. It was really simple back then, but 2 or 3 years ago was not such a great time to invest. It was a great time to be a seller, and that's why I sold so much of my portfolio. But now, when it's difficult to raise money, this is actually a much better time to invest than it was a couple of years ago. So, how do you balance that out? And as an investor, how do you think about getting into an opportunity when maybe you have other passive investments that aren't going well? And now you're getting pitched a new deal, and you're like, I want to see my old ones get fixed before I, invest in a new one. And is that the right move to make? Well, I'm going to give you some data points to think about. And if you're a syndication sponsor and you're raising money from other investors, I'm going to give you some talking points that you might want to use in your conversations with passive investors to show why now might be a better time to invest than it was before. First of all, is today's basis versus the peak. Prices today are much better than any time in the last 4 years. I was telling Tenny and Leslie about a property that we had under accepted LOI 3 years ago. And instead of going to purchase contract, the seller decided to default on the LOI and say, you know what, we changed our mind. We decided we're not going to sell. Instead, we're just going to hang on to the property for another year, and we're going to sell it next year for even more. It was partly because they didn't think our offer was high enough. Even though they accepted it, they got cold feet and they got seller's remorse. Well, 3 years later, that property, still owned by the same owner, is coming back to us with them begging for an offer. And if we do decide to write an offer, it's going to be about $20 million less than the offer that we wrote them 3 years ago. So if you're a passive investor investing in real estate syndication, would you rather have bought 3 years ago for 20 million more or buy today for 20 million less? I think just the sheer basis play gives today a bit of an advantage. But that doesn't mean that there's not risk. There are a lot of unknowns. Cap rates is a big one. We don't know where cap rates are headed. Everybody has an opinion, perhaps, on where cap rates are headed, but nobody knows for sure. Interest rates are another unknown. There's a lot of talk about interest rates declining, maybe as early as week after next when the Fed meets on the 16th. But we don't know for sure. Maybe rates hold steady. Maybe something happens and rates go up. Who knows? Interest rates are never a sure thing. Rent growth. We don't really know where rent growth is. We've seen negative rent growth here recently over the last couple of years in a lot of markets. Some markets are flat. Some markets are slightly up. We just don't know where rent growth is headed. And when you think about cap rates, people have a tendency to tie cap rates to interest rates. Well, I can't pay a 5 cap when interest rates are 5.5. Okay, fair enough. But cap rates are also very closely tied to rent growth. When rent growth is really high, cap rates will compress because you have a rapidly growing income stream. When rent growth flattens or turns negative, cap rates decompress because you have a shrinking or stagnant income stream. So just because interest rates go down doesn't mean cap rates will go down. Cap rates could still go up, even with declining interest rates, if rent growth doesn't come back into the picture. Another thing that's kind of an unknown is construction and absorption. We're at record construction levels right now, and all of the units being built are not being absorbed quickly enough for rent growth to play a role in today's apartment market in many areas. So, what's going to happen there? That's a risk factor. So there's some underwriting unknowns. And then there's the debt cost versus equity returns. It's really difficult to achieve 8% preferred returns on investor equity when you have 7% interest rates on your underlying debt. So, there's the negative leverage factor. How do you buy a property at a 5.5 cap in a 7% interest rate climate when you have negative equity? Negative leverage. It doesn't compute mathematically, especially without rent growth. So all those things are impacting equity returns, and that's making it difficult for investors. Now, I think the best time to invest in any real estate is when it's the most uncertain and when it's the most difficult for investors to actually give you a yes. That's going to be the best time to actually make an investment. Now, I've always said that you got to think about where you're investing. And I believe in investing in markets where people are moving to and avoiding markets where people are moving from. This map from the US Census Bureau shows exactly that. The darker the green, the more population that's moving there. The darker the yellow to orange, the more people that are leaving those locations. So you can see here, from the west to the east, you've got southern Nevada, Utah, Idaho, western Montana, Texas, Georgia, Florida, and the Carolinas and Tennessee are really strong migratory markets. And then you've got other places like California and New York, which are not so great. So, you got to think about where you're investing and where people are moving to, and invest in those areas where people are to. In the long term, those are always going to be the better performers. Now, having said that, there's a lot of new construction in these inbound migratory markets for a good reason. Developers saw all these people moving and they decided to start building units there. And that's created a situation where you've got these metros that have excess multifamily supply. And here we go, the Carolinas, Texas, Minneapolis, Knoxville, Tennessee. These are the top 5 markets that have excess supply. And then you have the bottom 5 markets for excess supply, meaning they actually have supply shortages in Tulsa, New Haven, Connecticut, Tacoma, Washington, Hartford, Connecticut, Little Rock, Arkansas. These were sleepy markets that didn't have a lot of rent growth, and therefore nobody was really building there. So they actually have a shortage of units. So that's created this interesting geographical supply and demand imbalances where some markets are much more affected than others. And how that translates into rent growth, we can see here the highest supply markets have some of the worst rent growth. If you take a look at new lease trade out means a new lease rented to a new tenant. What's the difference in rent between that new lease to the new tenant and what the previous tenant in that same unit was paying? And take a look at Austin. Austin has a negative 8.3% new lease trade out, meaning that their new tenants are paying less than the old tenants. And that makes it really difficult to get rent growth. Now, they are getting some rent growth on renewal lease trade outs for people. If you can keep them there, then you can get increased rates. And generally, that's because renewals are priced lower than new leases anyway, because they have catching up to do. So they are getting some benefit there. But the other takeaway here is that this shows that at least over the last year or so, it's been really difficult to execute a value add business model, meaning you go in, you renovate the unit, you rent it to a new resident at a higher rate, because this is where you're actually finding the most rental resistance is new tenants coming in. You're getting rent growth on renewals. So, a momentum play is actually a viable business model now where you can just grow the rents on your existing tenant base. Yet at the same time, value add business models are challenged because new incoming tenants have a lot of options with a lot of concessions, and you're not seeing the rent growth. But opportunities are coming. If you look at acquisitions in the last 4 years with 2 to 3 loan durations, there's 3,200 properties, and these are multifamily properties over 100 units in size. There's 3,200 multifamily properties that have been acquired since 2020 with 2 to 3 year loan maturities. That means their loans are already starting to mature, or maybe have already matured. And those people have to do something. They have to refinance, they have to sell, or they have to get an extension. Now, what's been happening over the last 12 to 24 months is those borrowers have been getting extensions from their lenders, but that kind of a party only lasts so long. Eventually, you run out of cake and the party is over. And when that happens, these owners are going to be forced to do something. And that's going to present opportunity for buyers to find properties. 1,700 properties were financed with floating rate loans after 2021. And you know what happened to their interest rates? They more than doubled. There's 3,500 properties with construction loans between 21 and 23. The property I told you about that we were going to offer $20 million less is brand new construction. When we first wrote the offer, only one building had been built, and we were going to buy it upon completion. Well, now they're facing a loan maturity and a $20 million haircut from our offer. But there's 3,500 other properties just like it that have had construction financing that they're going to have to do something. There's over 200 properties on the GSE watch list. This is the Fannie and Freddie watch lists where they think that there's loans that might have trouble coming, and that number is growing. And then there's over 2,000 properties with debt service coverage ratios less than 1.05, meaning they're break even. So you've got properties that are break even or losing money, being watch list by their lender, with loans coming due and interest rates that have gone up by maybe double, and you have all kinds of opportunities that could come your way. Some footnotes to this data. Just looking at markets that have at least $3 billion of multifamily loans coming due by the end of next year include Atlanta with $11.9 billion in maturing loans, and Dallas with $8 billion, Denver with $7.2 billion, Houston $5.7 billion, and Chicago $5.5 billion. That's a lot of opportunity that's going to be coming. Let's see, anything else in here that's of interest? Yeah, markets with a high percentage of loans maturing with negative rent growth are Atlanta, Houston, Raleigh, Durham, Orlando, and Austin. Those markets have had negative rent growth over the last year or two, and they've got a high percentage of maturing loans, so that's going to spell some multifamily distress. Here's a chart that came out today. I actually just updated this next slide about 10 minutes before we went live on today's presentation. So this is hot off the press. Cred IQ came out with some statistics on distress in multifamily loans and other commercial real estate. This is CMBS loans, commercial mortgage-backed securities. It's limited to that subsector alone. So this doesn't include every loan for commercial real estate, but it does include stats on CMBS loans. And multifamily distress hit 11% last month. But what's even more interesting than that is if you look at what I've highlighted in red, the progression of the growth of that distress is what I find most remarkable. in that there was very little distress, even as much as a year ago. It's more than doubled just in that last year. So it's gone up quite a bit, even just since March. It had started to go down by January, hit 2.6%, but now at 11%. You think that's bad? Office is worse. Retail's been jumping around a lot, but most of the passive investments that the retail investors are investing in is multifamily. Not most high net worth retail investors don't invest in office and retail, commercial real estate, industrial, hotel, and self storage to the extent that they invest in multifamily. That's why I highlight this as kind of being most interesting. In a graphical format, this is kind of the same data, but in a chart, you notice the light green line that I put the arrow on here is multifamily distress. Now, multifamily distress doesn't mean it's in foreclosure. It means that it's either on a watch list or in special servicing or is in default. And the steep climb of that light green line is pretty interesting. And then this piece here shows the payment status on this distress. The light blue, that's 31%, is current on their payments. And then the red is non-performing matured, and the kind of darker purple is performing matured. So you can see that out of all this distressed debt, half of it has already matured, and they have to do something. They're going to end up in foreclosure. The lender's going to force a sale of some sort. But there's a lot of maturing debt that's causing problems. And you notice that the slices where they're in payment default, which are the greens and yellows, the payment default is actually fairly low. The highest one, of course, is the 90+ day delinquent. It's 10% of the distressed loans are 90+ delinquent. But the biggest ones here are either current and in distress or matured already and in distress. But the momentum is building. This article came out, just about a couple weeks ago. In the second quarter of 24, multifamily absorption reached a 24-year record high with 390,000 units leased over the past 12 months, which is the highest figure since 2000. This is leading to a decline in multifamily vacancy and is going to help stabilize some of these markets and bring rent growth back. Here's a graphic showing the demand surge from RealPage. Looking at over here on the far right, this dark blue is the first quarter. And you can even see how that increased dramatically over the fourth quarter of 2023. So demand is certainly picking up. At the same time, development is cooling. We looking at the green bars here, you can see we peaked out in the Q1 of 2023, and we've been steadily declining in units under construction. This is already underway, and we've fallen by about, I don't know, maybe 20% or so, from 6% of inventory. This is the orange line, down to about 4.5% of inventory. And that number is expected to continue to fall. And what that's done is it's given the market a little bit more confidence. This chart of cap rates has a lot of moving parts, but as I break this down, going in cap rates are in the light green. So you can see that going in cap rates have started to decompress. In other words, they're going up. And when cap rates go up, prices go down. So this is showing the decline in market value right here. But what I find really interesting is if you look at the last 3 quarters, those green bars are pretty equal to one another, except for the last one is slightly lower. So you'll see that it looks like, according to this, cap rates may have peaked and are just ever so slightly starting to decline. Now, whether that's sustainable or not, no one can say for sure. But to see that this has stabilized for 3 consecutive quarters and is now even showing some signs of slight compression is a good sign long term for exit cap rates. Exit cap rates are the dark green bars here. And you can see that exit cap rates have started to level off as well in the last 3 quarters. But what I also find that's really interesting is if you go way back here into like 2019 and 2020, notice how there's a big gap between the green bar, the light green bar, and the dark green bar. This means that, like, for example, in the Q3 of 2020, going in cap rates were 4%, exit cap rates were like 4.75%. So that means that buyers were assuming cap rates were going to get 75 basis points worse than at the time they buy, which is a prudent thing to consider. When the market is really hot, you would assume that over time, the market will become less hot and therefore cap rates will decompress. But if you look at these latest quarters, going in and exit cap rates are almost equal to one another, which is showing that buyers are exuding some confidence that cap rates are going to stay level and not just go up and cause valuations to have headwinds from decompressing cap rates. I've often heard people say, like, oh, it's ridiculous to assume that you could say that an exit cap rate would ever be lower than an entry cap rate, which is a contention that I disagree with. If you bought a property in 2009 when the market was absolutely terrible and sold in 2015 when the market was great, your exit cap rate absolutely would have been compressed from your entry cap rate. So if the market gets better during the hold period, then exit cap rates can in fact be lower than entry cap rates. Whether that's a prudent underwriting standard is a question that no one can really answer. But you'll see here that the spread between entry and exit cap rates, which is this light green line, has reduced to only 10 basis points. That to me is a good sign that the market's starting to stabilize. How far down has it gone? Well, this chart came out by, I think it was Realty Shares put this out, showing the 2008 Great Recession had a 29% decline of pricing from market peak, and that this cycle is a 35% decline from the market peak. I believe this chart. I think this is true. In fact, some data that I have supports as much as 37% decline in market value from the market peak. So this could be a steeper decline than even the Great Recession, representing an even better buying opportunity than perhaps buying coming out of the Great Recession. You can show here, this also was put out by Realty Shares, that there's this period of depressed pricing is arguably the most attractive investment opportunity since the 2008 global financial crisis. Whether or not that turns out to be true, no one will know for sure until after the fact. I do disagree with their forecast recovery chart showing this almost immediate recovery beginning in early 24 and then accelerating through 25 and 26. I think this flat period here is going to last a little bit longer, maybe all the way into 25 before it starts to climb. So there's a little bit of time to be able to find deals as some of these loan maturities and stuff work their way through the system. Hopefully you've got your questions that you've thought of, because I'm about at the end of my remarks. So if you have them, be sure to type those in to the chat box, or Leslie or Tenny can tell you if there's a different way they want you to deliver your questions when I turn this over to them. But I think what I want to stress in my closing of my prepared remarks is that when you're investing in passive real estate syndications, you need to know the basics of underwriting property. That is true. But you also have one additional component that you have to underwrite, and that is the sponsor that you're investing with. Sponsor selection is critical because a good sponsor can finagle the best outcome in the face of adverse circumstances, and a bad sponsor can destroy a perfectly good real estate deal. And over the next, over the past year and over the next 2 years, we're probably going to see revealed a lot of which category different sponsors fit into amongst those two choices. Don't forget to check out the Hands-Off Investor, which you can find at biggerpockets.com/syndication book. If you get it from there, they give you other free stuff like some bonus content that might be cool to have. So, you might want to check it out. I don't know if the price is better on Amazon, then maybe you just get it from there. I don't care. I don't make a lot of money off writing books. I'm not here to sell you a book. I don't make my living off of this. I make my living off of being a steward for my investors' capital, making sound real estate investments. And this book really is here to help out passive investors to make smart choices. That's why I stress this book. If you're a syndication sponsor, this book has all the answers to the test questions, because your investors are going to be asking you things. And if your answer is, I don't know, their answer is, I'm not writing a check. The answers are in here if you want to search them out. And if you want to search us out, you can find us at praxcap.com. Bob Dreer is our Senior Vice President of Investor Relations. He can help you out with anything that we have going on, which is nothing. We haven't bought anything in 3 years. We sold most of our portfolio right before the drop, and I'm waiting to buy until I think that the time is right, which could be now if I can find the right deal. So Leslie and Tenny, I can turn this back over to you, and you can tell me how you want to handle it from here, but I'm happy to answer any questions that anybody would have.
Absolutely, Brian. Thank you so much. Thank you. Thank you. Just some comments I'm getting people texting me, sending messages on LinkedIn. Like, what a service you guys are doing to the community. Free, priceless knowledge. This guy is a genius. I couldn't agree more. I have a ton of respect for the value that you bring. And again, thank you so much for taking the time to share all of these wonderful nuggets with our community. We have some questions coming in here. So what I think Sean Clare is asking, what does it mean about the loan maturing? I think he's trying to say what you mean by loan maturing.
Great question. If you're borrowing money to finance your personal residence, you probably got a 30-year fixed rate loan where your interest rate was fixed for the entire period of your loan, and you made payments on that loan for 30 years, and at the end of the 30 years, your loan is completely paid off. That kind of loan product does not exist in the commercial real estate space. Because these loans are very large, they have to sell securities to fund these loans. And these securities, which are bonds, have a limited lifespan. So you might have heard about investing in a 10-year bond, for example. Those 10-year bonds might be backed by 10-year real estate loans against commercial real estate. So that means that when the loan matures, you have to pay it off. So unlike a residential loan where you pay it off in payments, in the commercial space, you make payments every month. And then when the loan matures, you pay the whole thing off. So let's say it's a 5-year loan. You have to pay the loan off in 5 years. You'll make payments for 5 years. At the end of 5 years, there'll be a balloon payment. And at that point in time, you're going to have to either sell the property to pay the loan off or refinance the loan with a new loan that might be for another 5 years, or it could be 7, or it could be 10. Loans going beyond 10 years in the commercial real estate space are very rare. There is a loan product that goes longer by the Federal Housing Administration, these HUD loans, but they're so cumbersome. You probably aren't going to want to do those. I mean, maybe you will if you got an iron stomach, but you probably won't. So that means that you have this maturity risk. And the worst thing that can happen to you is to have your loan mature right in the middle of a down market cycle. And so, when some borrowers were borrowing with 3-year maturities, and they bought in 2020, 2021, 2022 with 3-year loan maturities. That means their loans have to be paid off in 2023, 24, or 25. And we're in the middle of a down market. So now the property is worth less than the loan amount because the value fell by 37% or 35%, according to that one chart. And you only put 25% down, or maybe you put 15% down, and now the property is worth less than the loan amount, and you can't sell because you can't pay off the loan, and you can't refinance because nobody's going to give you a loan at that loan to value ratio. So you find yourself stuck. Loan maturity risk is the greatest risk in commercial real estate, which is why I encourage you to get the longest loan maturity you can. Generally, that's 10 years. 5 years is acceptable, especially if you're in the middle of a down market. The chances of being in a better market in 5 years are good. But if you're in a really solid up market, a 5-year loan maturity could be risky because that down market's coming. And if it comes right when your 5-year loan matures, you've got a big problem. So that's what loan maturity is, and that's the risk behind it.
All right. We have some questions coming in from LinkedIn. Mr. David Harrison, thank you so much. I see you're very active with some questions. David Harrison is asking, wants you to talk about IRRs and cash on cash returns. And another question was about finding JV sponsors.
So IRRs and cash on cash returns. IRR stands for internal rate of return. It's the return that you would get on your investment, factoring in for all cash flow movements and the timing of the cash flow. The definition of IRR is meaningless. I think the definition is the rate of return that results in the net present value of the future payments equaling zero, which that means nothing to anyone, right? So don't worry about that. And just think of like IRR is a souped up version of annual rate of return. So if annual rate of return means you invested 100,000 and you got $10,000 distribution, and then, a year later you got your 100,000 back, you would have earned a 10% annualized rate of return because you got 10,000 on your 100. IRR is a similar concept to that, but let's say that you got 10,000 in year one, 15,000 in year two, and then you got half your capital back. So now you only had 50,000 remaining. And then that year you got a $7,000 distribution. And then the year after that, you got a $20,000 distribution. And then you had a $10,000 capital call where you had to put money in. How do you calculate the annualized rate of return given all those movements of capital? It's nearly impossible. So IRR does all that for you, and it will create a rate of return factoring in all those movements of cash flow, as well as the timing of the cash flow. Like, did you get a big chunk early and then a lot later on? That's worth more than getting a lot later on and very little early. So IRR is just a great way to compare one investment to another. Cash on cash return is simply a measurement of what you receive each year as a percentage of the amount you invested. And that's in actual distribution. So you got 10,000 distributions on your 100,000, 10% cash on cash. Then you get half your principal back. Now you got 50,000 remaining in the deal, and you get 10,000 again. Well, that's a 20% cash on cash for that year because you had half the amount of cash. So just a good way to compare investments. And really what's most important is what's most important to you. Are you a cash flow investor because you're retired and you need the income? Or are you a growth investor because you want to grow your portfolio? That's going to dictate which investment measurement is going to be more important to you. And how do you find JV sponsors? Network. Go to conferences, talk to people, talk to brokers, talk to other sponsors, get in a mastermind group. This is a relationship business, I think is probably the most important message I can convey as it relates to actually finding deals, finding money, and finding partners. It is a relationship business. And just like anything else, relationships are developed, not found. So you have to work for that. Hopefully that answers the question.
Thank you, Brian. I hope you have a few more minutes because we have some great questions coming up. There's a question here from Miles. I think he's asking about one of the chats you showed, like what happened to self-storage in January 2024, where there was a spike in distress.
Yeah, I saw that too and had the same question, and I didn't get an answer to it. This data was assembled by CredIQ. I can only assume that there was some kind of data anomaly, like maybe there was one big loan that went into distress and came back out, which skewed the results, because it's a way off spike that isn't consistent with any of the other history. So I think it's just a data anomaly, and I ignored it and assumed there wasn't a systemic issue there, or it would have continued.
All right. This the question from Nataki, I like it a lot because you are the one person that I've heard explain this very well in a simple terms for investors to understand. And the question is, explain cap rates a little more, please.
Yes, this is a very difficult topic to talk about because it's controversial, believe it or not. This is one of the most controversial topics in all of commercial real estate because people place a very high emphasis. They put cap rate on a pedestal, like it's the holy grail to commercial real estate investing. And personally, I kind of think cap rates are meaningless. Here's what cap rate really is. Okay, let me start with a definition of cap rate. The definition of cap rate is you divide the income by the property value and you get a cap rate. So if the income is $100,000 and the property is $1 million, 100,000 divided by $1 million is 10%. That's a 10% cap rate. Now, you can change the order of the mathematics to arrive at a property value by saying, okay, $100,000 in income divided by a 10% cap rate equals a $1 million value. And this is where people go wrong in the commercial real estate space, is they say, okay, I have the income. I'm going to make up a cap rate. I'm going to divide the income by my made up cap rate. And that's going to tell me what the property's worth. And that's how much I should pay. And if anybody else pays more than that, then they're an idiot because they paid too much. And, you hear all this stuff all the time, right? That's not really how it works. Cap rate is merely a thermometer that is telling you the temperature of the market. The lower the cap rate, the hotter the market. It's an inverse thermometer. The higher the cap rate, the cooler the market. Now, why is that? That is because let's take $1 million property. $1 million property, no, not $1 million property. Let's take a property that has $100,000 worth of income. At a 5% cap rate, that's a $2 million value. At a 10% cap rate, that's a $1 million value. So that shows you how the numbers kind of relate to each other. Now, if you're in a really hot real estate market, Phoenix, Arizona in 2023, when rent growth was 30% and interest rates were 3% and everybody was moving there and it was a really hot market, cap rates got really, really low. At the same time, you could go to maybe, I don't know, Timbuktu, Ohio, if there is such a place, and nobody's moving there and, properties aren't doing very well and there's no rent growth. It might be a 10% cap rate because that market's, you're not going to pay the same price for that income stream. So that's what cap rate really is. It's just simply a way of gauging the temperature of the market. Some people will say it's equivalent to the return you would earn if you paid all cash. That's kind of close, but it's also not really true because it doesn't account for closing costs. It doesn't account for capital improvements. It doesn't account for rent bumps from a value add business plan. So it doesn't account for financing and leverage. So that kind of doesn't mean a whole lot. Think of it as the temperature of the market.
All right. Yeah, I really, really love that explanation. One asks, how come this is a great time to invest if interest rates are higher than they were 3 years ago?
Because prices are lower. And if the lower price more than makes up for the higher interest rate, it's a better investing climate. And it gets even better if interest rates fall, because then you get the best of both worlds, a lower entry basis and a lower interest rate. Now, we don't want to invest that way, that we're banking on that to happen. We need to invest as if interest rates are not going to decline. But the story I related to you guys earlier about the property that we put had an accepted offer on, and now we're putting in an offer $20 million less, should tell you everything about why now would be a better time, even at a higher interest rate. That deal is going to be more profitable and less risk than it would have been had we bought it then at a lower interest rate.
All right. Another question from Miles. Brian, I know you mentioned you haven't bought in the last 3 years, but what markets are you looking into for the future?
I'm kind of looking in the same usual suspects, the southeastern US primarily, but really the southern US, Arizona, Texas, Georgia, Florida, Tennessee, the Carolinas are kind of my primary stomping grounds, Nevada, like Vegas specifically. Markets where people are moving to, not markets where people are moving from. That chart I showed with the green map, that chart is straight download off US Census Bureau's website. You can get it. You can go to the Census Bureau and, just search for the population movement by county map. And you can pull that map up and see where people are moving to. The green areas, that's where I'm buying. The orange areas, not touching with a 10-foot pole.
All right. And question here from Addy is does that mean that the syndications that are holding assets on good loan payment cycles in this market are actually doing great, even though the asset might not be sending distributions?
Maybe and maybe not. If it's not sending distributions, I wouldn't say that it's doing great. So everything comes down to vintage risk. If you bought a property or your syndicate bought a property in 2018, it's probably doing just fine, despite interest rate spikes, despite lack of rent growth, all of those factors. You're probably doing just fine because you've had a lot of rent growth since you bought. But if it's cut off distributions, it's probably worth more than it was when you bought it, but the cash flow isn't all that great because the interest rates went up or whatever, and they had to refi or they had a floating rate loan. If rates come back down, maybe the cash flow comes back. So it's hard to just broadly categorize, whether they're doing great or not. Now, if you bought something in 2022 or 2023 or 2020, God forbid, 2021, when prices were really high, those values have absolutely fallen. Now, whether or not they quote unquote do great, I mean, that's got to be relative. You have to grade on a curve. Did they do great for the time they were bought, or do they do great overall? They won't do great overall, but will they do great for the time they were bought? That's the big question. And the answer to that is, will they survive to the next market cycle peak? And the biggest determiner, if that's a word, on whether they survive to the next market cycle peak is, do they have enough time on the loan? If the loan's going to mature this year, next year, the year after, they might be in real trouble. But if you've got 4, 5, 6 years before the loans mature, what are the chances that values are going to return to previous levels in 5, 6, or 7 years? I think those odds are pretty good. And the property could come out where it's a break even, and that could be a really good outcome in the face of the situation we've found ourselves in this market, or they could be decent returns. It just really depends on so many factors.
All right. Question, what's your message to investors who are worried about multifamily valuations dropping 35% from the high per your slide and potential recession? How are you communicating to your investors that this is the best time to buy despite uncertainty?
Well, there's the real estate market and the stock market are the only two markets I know of where people fear a sale. If you go to the store and things are 35% off, you're like, yeah, I've been wanting that TV for like 2 years and finally the price is half off. I'm buying the TV. Well, this is the same thing. The property's on sale. That means that this is the time to buy. So am I worried about the fact that valuations already dropped 35%? Well, of course, I'm worried about that for the properties that are still in my portfolio. I still do own about 1,000 units. And how I'm communicating that to my investors is I'm showing them the current values. And it's like, look, guys, these properties have fallen probably 35%. And people are like, wow, that really sucks. Why'd you have to tell me that? Well, it's because that's my job. I'm the syndication sponsor. I'm here to give you the news, not make the news or tell you what news I think you should have. My job is to tell you the actual news, right? So, you have to communicate clearly with your investors the truth. And the truth is values have fallen. Now, if you own already, that sucks. If you don't own already, that's awesome. And that's the message. Is like, look, we're buying this for a lot less than we would have paid if we would have bought this 1 or 2 years ago. And that in itself is an opportunity. Now, what I would be worried about is, will values fall even further? That's the real concern. Do they fall another 35%? Well, I think the risk of that is less today than it was, say, 3 years ago when values were at a peak. So they might still fall some. But if you buy something today with say a 5, 7, or 10-year loan, the chances are, even if values fall for another year, that they're going to come back before it's time for you to be ready to sell.
All right. Another question is, as the loan matures, should cash flow or rate of return be at certain or minimum percentage or amount? I'm not sure. I think the question is like, should rate of return change as the loan matures?
Well, not really, but here's what you have to think about loan maturities. Sometimes loans have a 5 year, or actually they'll do like a 3 year loan with two 1 year extension options. And they say that you can just ask for an extension if you aren't ready to sell at 3 years. Well, the problem is those extensions generally will come with covenants that require specific things to be true before those will be granted. And one of those is oftentimes the cash flow of the property. What's the debt service coverage ratio, or what's the debt yield? Debt yield is kind of like cap rate, except instead of using purchase price, you use loan amount. So might have to meet debt service coverage ratio requirements or debt yield requirements to qualify for the 1 year extensions. So in that context, the cash flow and return are very important as to whether or not you're even going to qualify for a maturity extension. Um, Now, what you would just a regular extension, like let's say, or a regular maturity, like let's say you got a 7 year loan and you're approaching maturity. That means you've owned the property for 7 years. It would be very likely to assume that there's more cash flow at year 7 than there was in year 1. So you would think cash flow would definitely have increased. Now, what tends to happen though is return on equity decreases because the property went up in value in 7 years. The cash flow went up too, but the equity built up and caused the return on that equity to drop. That's one of the reasons why you sell your commercial real estate at year 5, 7, or 10 and invest in a new property with a new financing, so you avoid that return on equity erosion that happens when you do these so-called legacy holds, where you hold a property for 10, 20, 30 years and the property's gone up 10x in value, but the income's only gone up incrementally so. And now you've got all this equity that's earning a very low return, if that makes sense. So I don't know if that answered that question or not, but there's an answer to a few questions tied in there somehow, I think.
Yeah, I see Pam nodding her head, so that means you hit the spot there,
Okay,
Brian. We
great.
got a couple more questions from LinkedIn. One question was like, how can you find out the loan maturity of a commercial real estate asset?
There's data services that have that. I think CoStar has it. Cred IQ might have it. Yardi Matrix has it. And then there's another service that's the lenders use, and I can't think of their name of it anymore. I forget the name. Maybe somebody that's on here will remember what it's called. But all of these are subscription-based services. You can't just go onto Google and pull it up. These are going to be, this data is going to come from a data service that collects all this data. So every time a loan is originated, these data services will gather the information on that loan, like the loan amount, the lender's name, the interest rate, the debt service coverage ratio, the net operating income, the maturity date. They gather all this information. It goes in their database, and then they use that information to sell to people who want that information and run reports and look for opportunities and so forth.
Yep. And a question from Leah on LinkedIn. What sources do you use to consistently keep pulse on the market cycles?
I use CoStar. I use Axiometrics, which is put out by RealPage. Those are both subscription-based services. And I also use like tons and tons of free real estate news sources, like globestreet.com, CRE Daily, The Real Deal. I mean, there's just so many different real estate centered news sites that you can sign up for, like daily emails. Yeah, CRE Daily, somebody put in there. These are just like free newsletters that come to your inbox. And Globe Street is globest.com, I think. I think they abbreviated street.
Okay.
And then you get real estate news every day, and you just read the articles, and that actually shows you a lot. And sometimes I'll look at like Census Bureau data. Um, Another one, this is kind of an unusual one. Like if you want to know where people are moving to, U-Haul and Penske Truck Rentals on their press release websites every year, usually in January, February, will put out a list of one-way moving destinations, like who's renting trucks to go to where. And that's kind of an interesting thing to look at, like what cities are, where all these U-Haul trucks going. That's an indicator of where people are going, right? So there's such a variety of information out there. I probably spend at least 1 hour, maybe sometimes 2 to 3 hours every single day reading real estate news articles and data. And that's kind of how I stay on top of it. You can't make decisions from a vacuum.
Guys, I think there's no better way to wrap it up than that line right there. You see what it takes to become an expert. They say an expert spends 10,000 hours in their craft, and Mr. Brian Burke has spent probably 100,000 hours or maybe 1 million hours on real estate and commercial real estate. That's why he's such a great mind that we respect. Brian, we can't thank you enough for giving us the opportunity, for coming here and sharing your wisdom with members of our community. This has been a really, really valuable presentation. I'm getting a lot of comments from text messages, LinkedIn, all over the place about the value that you're dropping. And again, we're going to have the recording of this meetup that we're going to share with everybody that registered for the webinar. Brian, would you be kind enough to share your slides, if that's okay to share with them as well?
I will. I'll email those over to you guys.
All right. Thank you so much. I don't know if you have any final words, but thank you so much.
Yeah, thanks for having me here. Good luck in all your investing, whether you're on the active side or the passive side. I think that this is a great time to be thinking about what investments you're going to make as this market rides to the next market cycle peak. Good luck.
All right.
Yeah,
Thank you.
Brian, I'll be reaching out. Thank you so much.
Thanks, Denny.
All
All
right.
right, have a good one.
All right, everybody, you could hang out back as Brian leaves, just to network, get to know you, and see how we could be of value to you. Pam, I finally get to see your face. We've spoken so much on the phone and text messages. I never got to see your face. Good to meet you. You can unmute, you're muted. You're muted, Pamela.
I'm muted. Oh,
Yeah,
okay.
there you go.
All
I
right.
can hear
Nice
you
to meet
now.
you too. Yeah. Today was a off day, so
Okay, that's good. That's
working
good. Well,
tomorrow,
welcome.
10 hours. But yeah, I was no, it was great to hear the presentation. It surely helped a lot. I got the information off of the website for the wire transfer. I just so I'll take care of that this week.
All right. So Pam is an upcoming investor on our latest asset, which is Grove Park View. Tenny, I don't know. You look like you wanted to say something.
Yeah, everybody. This is the networking part of the event. So you can see Brian just dropped off. This is where you can come and ask your own question. I know you guys gave him a lot of questions. If there are any question he didn't answer and you want to communicate with him, please feel free to drop it. We'll send an email to him and ask him for him to respond to the questions. But please feel free to introduce yourself. And then anybody that comes up on the video feed, we're gonna ask them the questions and let them introduce themselves real quick. And all those on LinkedIn, I'm not sure if you're able to network here, but you can drop your chat on LinkedIn and then we'll get to know you as well.
And if there are any questions that you forgot to ask Brian, please feel free to ask. Again, this is our community. We're going to be doing this more often, giving a lot of value, bringing in other experts to come talk to members of our community about everything that's happening in the market and just anything that's going to bring value to you. And we're going to be doing a lot of presentations as well, because to give value so that you could leverage this knowledge and use it to build wealth for yourself and your family. So we're going to be sharing all the knowledge that we've gathered over the last 5 years, building what we've built. So hopefully it could be of value to you guys as well. And
can some of you go ahead, Les?
No, if you're not already part of our exclusive community, Adi, if you could drop a chat in the link, a link in the chat. If you're not already part of our exclusive community, go ahead and sign up. There's a ton of value on there. So be part of that community because you're going to be doing a lot of education and giving a ton of value. Tenny,
what are some of your takeaways? If you can drop some of your takeaways from the presentation on the chat, that would be beautiful. Because I'm sure as he's sharing the information, everybody's getting something different. So please, if you don't mind sharing, beautiful. If you don't want to share on video, maybe you all are scared of Leslie's face. I can assure you, he doesn't bite.
Tenny, what is your biggest takeaway?
My biggest takeaway is that, we're doing things the right way. We have a debt that we're assuming right now, a 5 years loan fixed on the asset that we're buying. We're buying the market that's growing. The sea population is growing. So as he's going through everything, I'm looking at the asset we're buying and the time we're buying it. And then when you talked about cap rate, where cap rate is about to drop, it went flat for a while, it's about to drop. I'm like, oh my goodness, we're in the money. So just looking at what he's saying and then mirroring that to the asset that we're buying, making sure that we're placing our investors' capital in a great deal. Those are some of the things I was just thinking as he's going through the slide.
One other big thing that mentioned is I think the line where he talked about real estate and stocks are the only thing that people are afraid to buy when it's on sale. I think that's a powerful thing, and the importance of understanding that when it's the most difficult time to raise capital, that's when is the best time to buy. And there's that inverse relationship where it feels like when people just want to throw their money and stuff, that's probably the worst time to buy, and that's what we're seeing right now with some of the deals that a lot of people jumped into that are struggling right now. But now when things are discounted, that's when people are backing out. So for you guys that are jumping in this and the first time, you're in luck because you're hearing about this the first time and you're jumping in at a time when assets, as you can see, are discounted at 35%. Whew. Can you imagine what 35% of $50 million is?
Yeah. I know. And another interesting thing he talked about, and everybody's seeing this in the market space, is the time right now is a hard time to raise capital as well. Even though now is it's a good time to buy, it's hard for people to understand that actually this is the right time for you to buy. That's why even when Buffett said, when there's blood on the streets, that's when you buy. That's when you invest. And then when everybody's jolly, happy, that's when you get out. That's exactly what he does. And that's why we respect him a lot. We kind of follow a lot of his philosophies to continue to learn from people like this, some of these veterans that have been in the game for a long time, and they understand this market cycle very well. Manny, that does our underwriting, Leslie, myself, chairman, that's Dr. Julius Suni. We've spent a significant amount of time studying his book. Manny has probably gone through his book that he talked about like 5 or 6 times. Has gone through again and again and again. And some of those principles are some of the things we apply when we're looking at deals, underwriting deals, and using those strategies to buy deals that we bring to our investors.
And it has saved us a lot. It is because one of the things when you get in the real estate space is there are a lot of experts. There are a lot of people that pull out a lot of information, but not every expert is created equal. This is one expert that I highly encourage you guys to listen to because he knows his stuff and he has the experience to prove it. So, and if you want any more experts or any people that we follow and listen to that we highly respect, more than happy to recommend them for you as well. So,
any other takeaways?
I have a question. Another question.
Go ahead.
Oh, I have a question. So what is your timeline for getting your investors? If you're looking at a certain property, do they give you, say, okay, you have 2 years, you have 3 years to raise the money for your purchase? Do you have set timelines, or you just wait until you get enough investors and then you execute?
That's a great question, Pamela. So typically it's 90 days, 60 to 90 days when you put the deal under contract to close. You have 60 to 90 days to close. But now in this climate where capital raising is tough, the average time period to close deals is about 5 months, right? Most deals are taking about 5 months to close. And even after you close the deal, the equity might still be open. A portion of that equity might still be open for investors to come in. So it is when that equity is fully raised that you start raising. The way most syndications are set up is like after you close the deal, you could have 6 to 12 months where you still continue to raise capital if needed to fill up that capital. So yeah, but most in a normal market is 90 days, 60 to 90 days, but in current market it's about 5 months that it takes to average to close the deal.
Okay. Thank you.
You're welcome.
There's a lot of people still on this call. Ask your questions. Don't be shy. I promise Leslie doesn't bite. And please share some of your takeaways as well.
All right. Well, it's 7:25. If we're not having any other questions, we'll wrap it up. Everybody that registered, you're gonna get a recording of this. Every member that's part of our community, this is gonna be in our community. It's probably gonna be one of the prized possessions. As Brian was talking, our team was going crazy in the background, like, oh my God, that's a clip right there. That's value right there. Everybody was getting so excited because the amount of, don't take for granted the amount of value and knowledge that was just presented this evening. Again, leverage it, use it for your own self, share it with others, invest, grow wealth. Don't keep the knowledge to yourself. Who else do you know? Share this knowledge with them because a lot more of us need to be getting into this asset, especially at this time of the market cycle.
And Leslie mentioned community. I want you guys to be very clear about what he means by community. XSITE Capital, I don't know if you all are in our mailing list. We've just launched XSITE Community. It's a closed platform where like-minded individuals come in and collaborate, where we have all the resources that we produced over the last 5 years. We've distilled a lot of them in there. It's not available to the public. It's only available to people that are part of our community. So if you've not had access to it or if you've not seen it, if you go in there, there's a lot of premium things that is not available to the public that you see there. Video content, discount on a lot of subscriptions. As an entrepreneur, one of the things that we do is register LLCs, right? On that platform, you're able to go in there and get access to something that you can use to go register your company at discount. There's a lot of different perks that's on that platform. There you can get access to us. Leslie like mentioned, we're going to be doing a weekly presentation about something. It's exclusive to folks that are part of that community. It's not open to the public. So please, the link, Adi dropped it on the chat. Go ahead, be a part of that community so that you can get updates. When we post anything, you're going to get a notification that an item has been posted in the community. Check it out. Check it out if it's useful for yourself. For example, one of the issues a lot of folks have had is they want to invest using their IRA account, but they don't know how to navigate that. We're going to be creating content about that and putting it in that community so that you can go there, educate yourself, and learn more about it. So please go ahead, be a part of that community. We can't wait to see you there.
All right. On that note, there's no better way to wrap it up than what my partner just said. On behalf of our CEO, Dr. Julius Oni, myself, Teni Tofari, and myself and my partner, Teni Tofari, and our entire team here at XSITE, we just want to say thank you. Thank you for taking the time to be here with us this evening. We hope you found a lot of value in this presentation. And I'll keep coming back. We are making a commitment to continue to deliver value to you. So you got to make a commitment to keep coming back. So